When I grew up, there was a song called The Times They Are A-Changing, and I'm not going to spoil your day by trying to sing it, but if you think about our economy and the property market and the world in general, boy, the times they are changing. But I'm still bullish about property in 2022, and that's what I want to discuss with you in today's show. But I'm also going to share with you a number of rules that you've got to follow this year where things are going to be different, some rules to keep in mind in changing times. So whether you're an experienced property investor or just a beginner, I hope at the end of today's show you're going to have some clarity and some better direction, because at the moment we're getting lots of mixed messages and you can't just go out and buy any property, so let me give you some direction. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
This year promises to be a fascinating year in real estate. While we're not going to get the same level of growth in 2022 that we had last year, there's still going to be substantial uplift in property values over the year. The difference this year, though, is our markets are going to be very fragmented. So in today's podcast, I want to give you my ideas about what's ahead, why I'm bullish on property investing this year still. And, you're going to say, hey, Michael's always bullish. No, I'm realistic. And then I'm going to share with you some ideas about some rules to use to follow in the markets that are changing in front of our eyes. Because last year was a relatively unusual year. We experienced a once-in-a-generation property boom where values grew almost everywhere around Australia. Now, if you've been a follower of my podcast, you know I mentioned that already 18 months or so ago. I warned that this was going to happen. Maybe warning is the wrong word. I recommended and suggested that people take advantage of that once-in-a-generation boom that did occur. But to be honest, I really didn't expect it to be as strong as it ended up being. You see, around 98% of locations around Australia recorded rising property values last year, with many locations, properties grew more than 20%. But this year, it's shaping to be a more normal market, where some locations are still going to see strong price growth. Some will experience moderate price growth. Some locations will languish, and a few locations will see property values falling. And of course, this is going to be dictated, as it normally has been, not last year, but normally by local supply and demand factors, by local economic conditions. Now, if you think about it, over this cycle, property values increased 20%, in many cases 30% in many locations, since the beginning of the pandemic, but at the same time, wages growth was minimal, meaning properties are going to be more unaffordable to many Australians who just can't borrow more because their wages have gone up 2-3% and banks are slowly raising their fixed-term interest rates and being a bit more careful. Look, we've already seen the first months of this year delivering minimal price growth in the two big capital cities, Melbourne and Sydney. Yet property values are still growing substantially in Brisbane and Adelaide, the smaller capitals. In fact, it's much the same around other parts of Australia. But in those big capitals, properties are only half the price of Sydney and Melbourne, yet wages are much the same. Now, don't get me wrong, I'm not suggesting there won't be capital growth in Sydney and Melbourne this year. There will be, but it'll be segmented to areas with higher incomes, where more affluent people live and where they can afford to and are prepared to pay more to upgrade their homes or live in aspirational locations. Other areas that will perform strongly this year will be gentrifying suburbs, where millennials are moving out of apartments and into homes as they form their families. That's that stage of the life they're at. And of course, many factors that led to the property boom of 2021 will still be in place this year. There's still going to be strong employment growth. Wages are going to continue increasing. There is going to be a shortage of A-grade properties for sale. And our economy, despite all the challenges, is going to keep improving, and consumer confidence is remaining strong. But there's also a number of other factors that are going to underpin our property markets this year. Finance approvals are showing that more investors are looking to get into the market, and particularly since rents are rising, the investors are going to replace the first home buyers who are now finding properties less affordable. Investors are also going to be encouraged, as I say, by just the higher rents that they're hearing about. Also, 200,000 visa holders are going to be coming to Australia over the next year as our international borders have now opened, and most will be coming to Melbourne and Sydney where jobs are located, and most are going to rent for the first couple of years as they find their feet in their new home country. And of course, large parts of Australia have unfortunately suffered terribly from the floods that occurred a short while ago, and that's going to take a number of properties off the market, creating even more supply and demand uncertainties. But I also see 2022 as being the year of a rental crisis. While the pace of house price growth is slowing, rental growth strengthened and vacancy rates around the country at the lowest they've been for a long, long time. In fact, the nation's facing a chronic shortage of homes available to rent. Similarly, a shortage of rental apartments is also developing. So while houses are in a terribly short supply, apartments, there was a few apartment complexes overhanging the market, too many apartment complexes built a while ago, people not wanting to live in them during COVID. They're filling up again, and that's only going to get worse over the next year with a lot of the overseas residents and travellers coming back as well. Now, this shortage of rental properties has evolved over the last 5 years. I mean, it started years ago when APRA decided to limit lending to investors. I think that was about 2017. And it was followed by all that rhetoric about the Labor Party removing tax incentives prior to 2019. And interestingly, there's strong anecdotal evidence that many property investors sold up their properties over the last year or two, encouraged by the news that property values increased significantly. A lot of estate agents are saying that they sold a lot of the properties off their rent roll because they go to the investors, the more naive investors, and say, hey, I've got a buyer for your property. Because, boy, there were a lot of buyers in the market over the last year or two, and investors are selling up, taking advantage of the rising prices. Of course, somebody else is going to take advantage of the long-term growth of their properties, but it means there's less rental properties on the market. Now, it is a good time to sell a dud property, but if you've got a good property, don't change your plan because the market's changed. If your plan was to grow wealth through property, keep your property. And the other thing is, don't be scared by the property pessimists. Don't lose any sleep with predictions that property values are going to drop 10, 15% in 2023. In my mind, the bigger bank economists are going to be wrong again, just like they were with their calls of a property Armageddon in 2020 and 2021. Unfortunately, these commentators have got a poor track record of getting the property market predictions right. They generally got them wrong, underestimating the strength and resilience of our housing markets. Similarly, their predictions that interest rates are going to rise soon, some even suggesting in June this year, are likely to be wrong. There's no doubt that inflation is going to go up, but until wages go up so that people can afford to pay for rising costs of mortgages and businesses can afford rising interest costs, until wages go up, the Reserve Bank's not going to want to stifle and stymie our nascent economic growth by putting up interest rates. So there is a conundrum, because I know the money markets are saying that interest rates should go up, are going up, they're banking on it in some ways, and there's no doubt that the banks have put up fixed term rates out of line with the Reserve Bank. But even when rates do rise, and they will eventually, history indicates interest rate rises don't necessarily cause a property market crash. In fact, for a property market crash to drop that 10, 15% that the banks are suggesting, it would require sellers, vendors, having to sell their property, having to sell urgently, and no one out there buying the property, so they've got to give them away. Now, of course, a crash could occur if Australia had a recession, but that's not on the cards. A crash could occur if unemployment rose and people couldn't pay their mortgages. Again, that looks unlikely in the near future. A crash could occur if households experienced mortgage stress. But in fact, most Australians are really well ahead on their mortgage payments at the moment. And the Reserve Bank's indicated that a third of mortgage holders are 2 years or more ahead in their payments. And of course, the banks have stress tested new borrowers to ensure they could maintain their repayments if interest rates rose 2 or 3%. Of course, if there were multiple rapid-fire interest rate rises, that could cause mortgage stress, but the Reserve Bank's unlikely to do that. It doesn't want the housing market to crash. So as I said at the beginning, we're in for a fascinating year in property in 2022, but one where those who make the right decisions are going to look back and be pleased that they bought a property at the price they did when they see how our markets are going to keep rising. But, as I've said a few times, it's going to be a very different year. So in a moment, I'm going to come back with another segment of today's podcast where I'm going to explain to you the rules that you're going to have to follow, the things that are going to change a bit in our markets this year to ensure that you're a successful property investor. But before I do, maybe it's just worth saying that at times like this, you really need a team around you. And it's not just a property strategist, because you need a holistic approach. A buyer's agent, buyer's agents can only tend to help you where they are familiar with and where they buy. And while we've got Australia's most prolific team of buyer's agents, they implement the plan the property strategists put together for our clients. And you need the right structuring, finance, advice to bring you into the percentage of investors where only 1% of investors own 6 or more properties. Interestingly, a recent audit, it was a year or so ago now, of Metropol's clients showed they're 7.3 times more likely than average to own 6 or more properties. And that's because we use a framework that's trusted and proven and put a plan together for our clients. So why not go to metropol.com.au and find out what my team could do to help you. Whether you're an experienced investor or even if you're just beginning, we'd love to help you on your property investment journey. Go to metropol.com.au and you'll find we don't sell property, but we give strategic advice to give you wealth-producing rates of return to create not just normal wealth, but life-changing wealth, and for many clients, intergenerational wealth. I look forward to being part of your ongoing wealth creation journey. Interestingly, everyone seemed like a genius, an investment genius last year when our property markets were booming. But when times get tough, when the circumstances change, when headwinds come up, it's important to listen to those who've got the perspective of having lived through a number of economic cycles and have invested successfully through a number of property cycles. And you should also be careful to listen to those who take a holistic approach to wealth creation. Now, sure, we've lived through difficult times in the past, and boy, over the last year or two, we lived in unprecedented times. But it looks like we're all learning to live with COVID, and the world is getting on, and we've just been through the biggest property boom in a number of decades, a once-in-a-generational property boom. What it's taught a lot of beginning investors is our property markets are resilient, but our markets are slowing down a bit, and there's lots of predictions that as interest rates increase, and they surely will. Who knows exactly when it's all going to start and when it's going to happen? It depends who you listen to. But there are all these predictions that the property market's going to slow down, and in fact, most of the economic commentators from the banks believe we're going to have a significant downturn next year. So what I'd like to talk with you about now is what to do during changing times like this. So why would you bother listening to me? Well, those of you who know me know that I'm going to be 70 this year, which means I've been investing in property for 50 years. Boy, I've lived through a couple of cycles and learned some lessons, sometimes the hard way. I've made more than my share of investment mistakes, but not that many over the last 20 years. And some would say I've educated more successful investors than anyone else in Australia. So let's have a talk about what's ahead. Now, don't get me wrong, I don't think we're going to have a property crash any time ahead, but I clearly see some headwinds that could slow us down, international issues, local challenges. And that's why I'm probably being asked by clients in the media, what rules do I apply at times like this when the market's changing in front of our eyes? And I start by explaining that while I'm financially independent, I still intend to remain active in the property investment markets, which means I recognise I'm going to experience several more significant market downturns, several more property booms ahead as well. And I've learned not to change my strategy every time the economy changes or our property markets change. I invest for the long term. So I don't get thrown off by either the good or the bad phases of the property cycle, because I know they're part of the economic cycle, and I recognise that while the ups and downs are short term, the long-term trend for well-located residential real estate has always been up. And it's been that way since Federation, and it's unlikely to change moving forward. Now, one of the big drivers of substantial property price growth over the last couple of hundred years has been that our population has been growing and our population has become more wealthy. And if you believe our population is going to keep growing and going to become more wealthy as we become a knowledge-based economy, then you should also feel confident in the long term of property. Remember, the Australian government's got a business plan. It's got a business plan to keep increasing our population and increase it to about 40 million people from the 25.5 million people we've got now by the middle of this decade. If you think about it, that means we're going to add something like the equivalent of a Sydney, a Melbourne and a Brisbane in that time. Where are we going to put them all? Where are they going to live? What sort of accommodation are they going to live in? Well, if our population is going to keep growing, and the government needs to, it recognises that's one way, and probably the easiest way of keeping our economy ticking over. It realises it's one way of paying the pensions and the healthcare funds of the ageing population, because we need more young workers to coming in. It realises that it's one way of starting to pay down the government's debts. If all that's going to happen, then we also have to understand that that's going to put pressure on certain areas of our property market, pushing up property values. So I'm comfortable that in the long term, the increasing wealth of our nation and the increasing size of our nation is going to be an important factor underpinning property values in certain locations, and we'll talk a bit about that in a moment. So I guess what I'm getting at is don't get caught up in any media panic, any media drama. I've learned to turn down the noise and be careful who I listen to, as should you. In particular, I've learned not to listen to the general media, because I know the job of the media isn't to educate us. I guess its job is to entertain us, to entice us to click on their links with seductive clickbait headline. And if, like me, you're also investing for the long term, let me actually share with you a couple of rules to keep in mind to help make it through the times that we're going to experience moving forward. And the first lesson I'd like you to learn, the first rule I'd like you to follow, is become financially fluent. The secret to financial freedom is to spend less than you earn, save the balance, and then wisely invest your savings in growing assets. I think it's important for you to learn how money, finance and the property markets work, and start investing as early as you can so you have time and compounding on your side. Unfortunately, we so frequently see people come to us at Metropole in their 50s and say, well, I want to retire in 5 years, I want to retire in 10 years, and all they've got is their home. Now, they may well have paid off their home, but they don't have a large asset base working for them. So between now and when you want to slow down, your job's to build an asset base. If you have a big asset base, you'll have choices. I don't know what the rules are going to be when you retire. I don't know whether you're going to be able to negatively gear. I don't know whether the government's going to let you live on your super or you've got to actually keep it for longer. There's so many unknowns. But what I do know is if you become financially fluent and you save and you invest and you build asset base, you're going to have choices in your life. And if you don't have a big asset base, you're going to have fewer choices. Living on the pension isn't fun. I think it's something like $36,000 a year for a couple at the moment. Don't know how people survive on that. Now, along the way, you're also going to have to learn from proven mentors, and you're going to have to get a good team around you. But I think it's important for you to have a thorough knowledge base. You can't delegate. You can't outsource some tasks. Sure, you can outsource many of them, but it's really critical for you to understand if you're being given impartial advice or if you're being taken advantage of by many of those people with vested interests who are just after your money. So the first rule is become financially fluent and invest in yourself, and then learn to invest rather than speculate. I think one of the reasons most investors don't develop financial freedom, they don't get the levels of equity, assets, freedom they deserve, is because they don't understand the rules of money, and they end up buying their properties with emotion. Look, be it your first property or your next property, it really should be part of a long-term plan, a stepping stone to build a substantial asset base. But as I said, most people buy their investments with emotion. Look, we're human. It's normal. It's natural. So how do you stop the emotion? What we suggest is you start with a strategic property plan. In fact, that's what we always do when we see clients at Metropole. We start by building them a plan, which is really bringing their future into the present and then allowing them to do something about it. But if you don't have a plan, it's actually so easy to get caught up with emotion or with the media. People are looking for properties they'd be happy to live in or buy in suburbs near where they live, or where they want to holiday, where they plan to retire. That may not be the right answer. In fact, a study I remember reading a couple of years ago is most people buy close to where they live, and you would think it would give them some insider knowledge into getting a good deal. But this university study showed no, it didn't. It actually didn't give them an unfair advantage at all. And of course, property investment is so different from buying your own home. You need a well-thought-out strategy with measurable goals. By having a plan, by having a system to gauge the worth of investment, that'll help you achieve better results. But it can't be any old strategy. So my rule number 2 to keep in mind for changing times like this is adopt a proven investment strategy. Now remember, 90% of property investors never get past their first or second investment property. So don't follow the herd. Don't follow the strategy that most property investors follow. Otherwise, you're going to get the same results as them, won't you? In my mind, residential real estate's a high growth, relatively low yield investment. So I recommend a capital growth investment strategy. Now, I know a lot of people invest for cash flow because they're not good with their money, and so they're wanting more cash flow. The problem, of course, is if you're not good with your money, if you haven't got good money management skills, buying an investment property and taking on the loans and the commitments from that is only going to get you into more trouble. Now, I accept that cash flow is important. It keeps you in the game, but it's really capital growth that'll get you out of the rat race. So first, concentrate on building a substantial asset base over a number of property cycles, and then you can slowly lower your loan-to-value ratios, and eventually you'll be able to live off your cash machine. It's just too hard to become rich the other way around from savings or cash flow. If you think about it, when you retire, the majority of your assets won't be money you've earned. It won't be money you've saved. It won't be rent you've received. It'll be the tax-free capital growth of your assets. So that's why you should invest for the long term and for capital growth. Wealth's created by building a substantial asset base, and you achieve this by holding good investment properties for a reasonably long time, reinvesting your income, and allowing your capital to build up, to get the capital gains to build up, and use gearing, leverage and time to get you where you want to get to. The third rule I'd like to share with you today for these interesting times is, you've heard me say before, not every property is an investment grade property. While virtually any property can become an investment, you just put the tenant in, few properties are investment grade. In fact, we believe currently less than 4% of the properties on the market are investment grade that are going to strongly outperform the averages over the long term. Remember that while the location of your property will account for 80% of its performance, it's also important to own the right property to suit the local demographic. The next rule I'd like to share with you is don't believe the hype. Be careful who you listen to advice. There are some great independent advisors out there. So sure, my team at Metropole are independent because we don't sell property, which means that if we give you advice, it doesn't necessarily mean buy a property. In other words, a lot of buyers agents, they only make their money out of buying a property and in a particular location because that's where they're specialised in. In my mind, that's not independent advice. So what I'm suggesting is don't get advice from those with a vested interest. There are great independent advisors out there, as I said, not just my team at Metropole, but the market's flooded with developers, property marketers, real estate agents who don't really have your best interest at heart. And of course, as I said, don't believe all the hype in the media. It's too easy to get caught up in the excitement or the panic and drama. So maybe it's worth trying to switch off the nightly news just before the finance segment comes on, and maybe watch some bad reality TV instead. Now, something you've often heard me say in these podcasts, the next rule is the location does the heavy lifting. It'll do, about 80% of the heavy lifting of your property's performance, and that's why I only invest in select suburbs in our 3 major capital cities. Now, I know there's always going to be people telling you to invest in regional Australia, but why fight the gorillas? Why fight the big trends? Moving forward, most of the jobs, most of the higher paying jobs, most of the wages growth, most of the population growth, and most of our economic growth and our economy happens in Australia's capital cities. And in particular, in our three big capital cities. And I like investing in the inner and middle ring suburbs, which are always going to outperform with regard to capital growth because they've done so over the last 40 years. That's where the amenities are, the lifestyles are, the more affluent people are, the gentrifying suburbs are, the suburbs where people have paid off their homes are. Now, interestingly, it wasn't always that way. At Federation, regional land in the big country towns was as valuable as capital city property. I mean, you can often go through some of those beautiful old country towns and see big mansions on large estates. So way back at Federation, regional land was as valuable as capital city property. Then we became an industrialised country and people moved to the city. Now, we no longer manufacture goods. It's all about our services. We're a service-based economy. That's where the higher-paying jobs are. These are the people with more disposable income. Now, by the way, I've always recommended investing in locations where people have higher disposable incomes and they're able to, and they're prepared to pay a premium to live there. And as I said, these are the more established suburbs of our capital cities and the surrounding gentrifying suburbs, the aspirational suburbs around them. Now, I can hear some people thinking as I'm saying this, Michael, that's not fair. All the good land's taken. It isn't affordable to invest in the big three capital cities. The fact is, the way people are living is different today. We're trading space for place. Yeah, we are trading backyards and balconies for courtyards. We're not wanting to live in apartments as much, but that's going to happen in the future. But more people are living in townhouses, so buying a townhouse in the capital city would still work, villa units, and low-rise family-friendly established apartments. So not the new high-rise off-the-plan ones, but low-rise family-friendly apartments also make great investments. Now, I know there are people moving out to the outer suburbs. I know investors are moving out there too. But I'm not really convinced Penrith or Point Cook or Toowoomba will ever be more valuable than land near the harbour. Are you? Think about it. If money were no object to you, where would you choose to live? That's where you've got to invest. Now, the next rule I want to share with you is that demographics drives the markets. Over the long term, demographics, how many of us there are, how we live, where we want to live, what we can afford to live in, I believe that's going to be much more important in shaping our property markets than the short-term ups and downs of interest rates, consumer confidence and government meddling. Sure, in the short term, immigration is slower for a while. It'll pick up again. But over the long term, understanding the demographic trends, that's going to ensure you're in the right property in the right location. And that's why I have a regular podcast with leading demographer Simon Kirstenmacher. About once a month we get together on the Michael Yardney podcast to help you understand those demographic trends. Now, the next rule I'd like to share with you is one you've heard me say over and over again, but it's important to understand. The real estate investing is a game of finance with some properties thrown in the middle. Now, cash flow management is critical to successful property investing. I already mentioned that. But today more than ever, you've got to have the right finance strategy. It's important. What's going to happen to interest rates? How are you going to service your loans? How much financial buffer do you have? Because smart investors don't just buy properties. They buy themselves time to ride the ups and downs of the property cycle. So a smart finance strategy has very little to do with interest rates. It has more to do with the correct finance product and setting aside, as I said, a financial buffer to buy you time. The eighth rule of property investing in changing times is that our economy and our property markets move in cycles. I guess one of the most significant trends I've seen over and over again in that almost 50 years I've been investing is that investment markets constantly go through cyclical phases of good times and bad times. However, there's a common fallacy that Australian property cycles last 7 to 10 years. I've heard other people talk about an 18-year cycle. Property cycles vary in length and are affected by a myriad of social and economic factors, and then at times the government lengthens the cycle by lowering interest rates and creating longer property cycles, or shortens the cycle by changing economic policies or rising interest rates. Now, this is going to be a short property cycle this time around. The current cycle was held up a bit by COVID. It stopped and started, but it really got going in October 2019, but it started off quickly, got cut short a bit by COVID, but it went straight into the boom phase. So the cycles vary in length. Now, one of the big factors is market sentiment. It's one of the key drivers of property cycles. One of the reasons our markets overreact. They overshoot the mark during booms, and when people get too depressed, the market slows down during slumps. Now, of course, cyclical events can create opportunities. Remember that every property boom sets us up for the next downturn, just like each downturn sets the scene for the next upswing. But it's important to try and avoid being thrown off by having a well thought out long-term investment strategy. So don't let the cyclical swings in the market affect you in the long-term investing that I'm suggesting that you do. It's difficult to make sound financial decisions unless you know what you want to achieve. But if you don't have a plan, you tend to default to what other people are doing or what the media is telling you. And that's why I suggest you have a look at what we do at Metropole. Go to metropole.com.au, find out about our strategic property plan. Just inquire, have a chat with one of our team about helping you build a plan as well. I recommend that you do that because, as I said, it's basically bringing your future into the present. You can do something about it now. But having a plan gives you direction. It gives you clarity. It gives you results. It gives you certainty about the future. As we're going through the property investment rules that I believe you should keep in mind in changing times like this, I'm going to recommend you follow my 6-stranded strategic approach. We have developed a framework. I have, and now my team have, and there's over 80 people in the team at Metropole. We've been involved in more than $4.5 billion, with a B, I almost said million, $1 billion worth of property transactions. We've managed over $2 billion worth of assets for our clients in our property management departments. So we have a framework to create clarity, to create certainty, to outperform the averages. So I'd suggest you only buy a property that would appeal to owner-occupiers. And that's not because I want you to sell the property that's going to be bought by owner-occupiers, but owner-occupiers will be buying similar properties to you, pushing up local real estate values. It's going to be particularly important as the cycle moves on, as investors are going to move out of the market when the market slows down. Secondly, I'd only buy properties below their intrinsic value. That's why I avoid new and off-the-plan properties, which come at a premium. Now, that's not totally true because almost all the investments I bought recently are new, but they're ones I've built, I've developed myself. So I actually didn't buy them new. I bought the old land. I bought the worst house in Great Street and then pulled them down and built townhouses. That's a strategy we do for a lot of our clients. And if you're interested in understanding about the development process or the land banking idea, just have a chat with my team at Metropole. I also only would buy a property with a high land to asset ratio. Now, that doesn't necessarily mean a large block of land, but buy a property where the land component makes up a significant part of the asset value. So if you buy an apartment where there's 200 apartments on a block of land, it would have a low land to asset value. On the other hand, if you buy an apartment in a block of 10, then it's got a tenth of the land. If it's in a great location, that's a fantastic way to do things. They're established family-friendly apartments. If you buy a townhouse, it's probably got half the land block of land, hasn't it? Because there's another one next door, for example. But basically, house has got even the most land to asset ratio, but it's not how big the land is, it's the land that's in the right location. So as I'm going through my 6-stranded strategic approach, number 1, properties that have owner-occupier appeal. Number 2, buy below intrinsic value. Number 3, buy properties with a high land to asset ratio. Number 4, buy in areas that have got long, strong history of capital growth, but also ones that are going to outperform the averages because of the demographics in the area. These suburbs tend to be where, as we've already said, there more owner-occupiers want to live there because of the lifestyle choices, and it's where locals can afford to and prepare to pay a premium. But it's also where we have more affluent tenants wanting to pay a premium to live there because of the school zones, because of the lifestyle, because of the amenities, because it's going to be your tenant's ability to pay more rent over the years that's going to give you the cash flow you need when you live off your properties. I also like buying a property with a twist, something unique, something special, something different, something scarce about the property. And finally, I like properties where you can manufacture capital growth through renovations or redevelopment. I'd rather you do that than wait for the market to do the heavy lifting, especially over the next couple of years when the market's going to slow down a bit. The next rule I'd like to share with you is don't focus on bargains because they really have a future. In today's very informed market, there's very few bargains around. Sure, There's fewer transactions over the last year or two than there was before because buyers have been holding back a bit and sellers have been holding back a bit because of coronavirus. But there's always a flight to quality and buyers have become more discerning. So while it's often said you make your money when you buy a property, and that's true, it's not because you buy a cheap property. It's not because you buy a bargain. It's because you buy the right property. I'd rather pay 10, 15,000, 20,000 more and buy a property that increases 8% per annum than get 10, 15, 20, $30,000 off the property, but the property is a dud property that only goes up at 5 or 6% per annum. Now, that's still not a dud, but the difference in capital growth and in turn rental growth will make a big difference. So think about it. Properties no one else wants today that you're going to get cheaply are probably going to be the type of property no one else is going to want in 5 years' time. You've heard the clever people say it before. Price is what you pay, value is what you get. So buy the best property you can afford, the type of property you'd be happy to still be owning in 10 or 15 years' time. Because when this cycle slows down, and it will, and when we get to a flat period of the cycle, you don't want to be owning secondary properties. And the last rule I'd like to share with you about being successful in these changing times is allow for an X factor. Every year there's a few X factors, unforeseen events, unforeseen situations that blow away all the carefully laid plans. These X factors can be negative or they can be positive. They can be local, they can be from abroad. I mean, who would have thought a couple of years ago that coronavirus would have come? Then when we thought it was all over, there was another X factor of coronavirus. Now that's weird and that's unusual and that's a national pandemic. Who would have thought in 2019 that the Liberal government would have won the election? Everyone thought Labor was going to come in and capital gains tax would be changed and other tax benefits would have disappeared. Sometimes there are overseas problems, sometimes there are local issues. So I guess what I'm saying is make a plan, but plan for your plan not to go to plan. I've just gone through, I think it was 11 rules that you should keep in mind. If you want to keep up to date, please subscribe to my property update blog where you're going to get information from a wide range of property experts. And of course, if you don't already subscribe to this, if you just listened for the first time, why not subscribe to this podcast as well? But we are going through challenging times. We are going through changing times. But I guess the message I'd like to give you is that the long-term future of well-located residential real estate is secure. Make sure you've got the right strategy, the right team around you, the right plans, the right finance, the right tax structures, and then your financial future will be secure as well. I hope my chat with you today gave you the opportunity to see that there are still opportunities this year, but you've got to be more careful and you've got to think about property a little bit differently. And if you got some benefit from my chat with you today, I'd really appreciate it if you told somebody else who's looking for financial independence through property about the Michael Yardney podcast. You'd be doing me a real favour, but you'd also be doing them a favour because similarly, they're needing this sort of independent information. Now, I've also got a little gift for you, my way of saying thank you. If you'd like to gather a bunch of ebooks and reports, go to podcastbonus.com.au and just leave your details and I'll send you a bunch of reports and ebooks. And I'll be back again real soon, but you can catch me in between these twice weekly shows on social media. Just look for Michael Yardney, or why not join my private Facebook group where every day I leave some tips, some tricks, some information, some charts. Just go to Facebook and look for the Property Update private Facebook group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?